Hello, this is Melissa, your insurance exam queen. This will be a video lesson on term insurance. So a key thing about term, temporary. It's only going to last for a certain period of time. Now you can buy a 1-year term called an ART, annually renewable term. You can buy a 5-year term, a 10-year term, a 20-year term. I think the highest I've ever seen is a 30-year term. And I have a 30-year term. And usually they do 30 because that matches a mortgage. So a lot of people will buy term insurance to help them if they die. It'll pay off the mortgage for their surviving spouse. So those are generally the term periods. But the key thing about term is it is temporary. It will end. It will not go for your whole life. Another thing about term is you will see no benefit unless you die. You have to die during the term in order for the insurance to pay out. Otherwise, you will never see any benefit from the term insurance. Now, of course, if you have living benefits, like you are terminally ill, you're going to die, or you need a kidney transplant, you can tap into your insurance. But something major like that would need to happen in order for you to receive any benefit. But if you pay 20 years every month, like my policy is $28 a month for $250,000. I am paying that. I've been paying that. And at the end of 30 years, if I'm still alive, hopefully, none of that money will ever be seen again by me. It is gone. It is spent. And that is something about term insurance. Whereas whole life on the other side, that money is actually racking up and saving, and you will be able to see it again. Or have access to it. So with term insurance, there are 3 different types. So let's say that in any of these, so there's 3 different types. There is increasing term. There is level term. And there is decreasing term. Now, what makes this increasing, decreasing, and level is what is happening over here on increasing is that your policy starts, and it'll never truly be like 0. Maybe we'll start at like, I don't know, 5,000, but your policy starts low and then it goes up over time to, say $100,000. So all of these are going to be $100,000 example. So this is going up, going up, going up, going up, going up, going up, going up. What we're saying with this is that if you were to die right here, you would only access however much money is available at that point. So the sooner you die at the beginning of the policy, the less money you will receive. So maybe you die at this point, maybe you're only going to get, $20,000. If you were to die at this point, you might get closer to $90,000. So with increasing, what is increasing is the death benefit. This is the death benefit. This is good for somebody like a younger person who, might be a bachelor, but they may ultimately get married and have kids and have a family, but they don't need much insurance yet. So you buy the insurance, and maybe initially you just need enough money for your funeral so your parents can get your funeral for you. Then eventually you buy a mortgage, so then you have a house to protect. Then eventually you have a kid. You need more money over time. And that is an increasing policy. A level policy is where the death benefit starts at 100,000 and it stays at 100,000. It is level. It's always the same death benefit. Always the same death benefit. So if I were to die on day one, $100,000. If I were to die on the last day, $100,000. So that's what makes it. So remember, all of these are when you die. That's what makes it a level term. And let's throw in some examples here. By the way, let's say that you start this policy when you're 30 years old, and let's say it's a 20-year term, so it's going to go to your 50 years old. Same for this one. You start it when you're 30 years old, and it'll go until you are 50 years old. Same for decreasing. You start it when you're 30 years old, it'll go until you're 50 years old. So in an increasing term, basically the older you get before you die, the more money will pay out. In a level term, doesn't matter. You'll always get $100,000 payout, whatever the limit is, okay? Decreasing is the opposite of increasing. This is where your death benefit is going to start at 100,000, but then it goes down over time, ending at maybe 5,000. Like I said, it very rarely, if ever, goes to zero. So if you were to die early on, you might get a $90,000 payout. But if you were to die later on, you might get that, $10,000 payout. A decreasing is good. And so when would you get a level is probably the most common one, where you always want the same amount of money. This is like when you're raising kids, you've got a mortgage, you got young kids, you've got a mortgage. You want to take care of them until they go off to college. So in case you die before then, you've got an insurance policy that will pay out. That is level term. Decreasing is generally purchased to line up exactly with a mortgage. And this is kind of like collateral insurance too, where it matches your mortgage, right? If your mortgage starts at 100,000, you make a payment, it goes down, goes down, goes down. It's matching the mortgage. Some people will actually call this mortgage protection insurance because it will pay off your mortgage at whatever point you die with as much money as the mortgage is at that time. And mortgages tend to go down over time. So these are the three different types of term insurance. Technically, you also have one called an ART. An ART is an annually renewable term. And this is just 1 year at a time. So let's say I'm 22 to 23. 22 to 23. I'm going to pay my premium based on my risk of dying. Let's say it's $100 a year. Then from the ages 23 to 24, my premium is going to go up a little bit because I'm older. Maybe it's 105. So, and it'll keep going up a little bit. With an annually renewable term, it renews every single year, annually renewable, and it's only covering you for exactly that 1 year of time. And this is actually known as the purest insurance. The purest insurance, because it's only covering you for 1 year at a time. When you buy this level term, you're basically saying, I'm 30 and just as healthy as I am for this entire time, even if my health changes. That's why annually is more pure, because it recognizes that you get older. It recognizes that things happen. And so you're paying for each year that you get older and older and older. Art is not something that you want to buy for the long run. And most people don't buy an art. It's used inside universal insurance to calculate the premium, the cost of insurance, but people don't generally buy an art all by itself. But that is one type of term. So you have an art, annually renewable. You have increasing, level, and decreasing. Level and decreasing tend to get asked about a lot more. Some states don't even cover increasing on their exam, but I put it in there just in case. And you as an insurance agent should probably understand all three anyway. Now, a thing about either of these is that the premium is always level. So across all of these, the premium is level. What that means is that if on day one, my premium is $10, on the last day, my premium will be $10. Now, that's another reason that someone may buy increasing versus level. Increasing will ultimately be a little bit cheaper because the insurance company isn't on the hook for the same $100,000. If you die over here, you know, they're only paying out $10,000. So they're not on the hook for the same amount of money. Level might be a premium of, say, you know, $20, but it's going to be $20 every single 20. It'll always be $20. That's what level premium means. Premium is level, it stays the same. So you may have, your increasing may be a $10 premium, but it'll be $10 the entire time. Your level may be a $20 premium, but it is $20 the entire time. Decreasing may be a $15 premium, but it is $15 premium the entire time. It is level, it stays the same. Okay. All right, so this is our video for term. It's actually relatively simple. It's learning the difference between the three types. Increasing, the death benefit goes up. Level, the death benefit stays the same. Decreasing, the death benefit goes down. And the premium is level the entire time, which means the premium stays the same the entire time. You also have an ART, which is an annually renewable term. The premium is going to go up every single year based on your new age. And it is known the purest form of insurance because it's judging you 1 year at a time, who you are, what age you are, exact time. Whereas increasing, level, or decreasing is going to lock in your rate for a while. It locks you in for 20. It establishes you as 30 and keeps you 30 essentially throughout the life of the policy. And that's why it's better to buy insurance the younger you are. The younger you are, the cheaper it's going to be, the less expensive, the easier to get as well. ART is not generally something you buy by itself, but they use ART to calculate the premium inside a universal policy. And we'll talk more about that on the universal video. So this is term insurance. This is your insurance exam queen, sending you all the loves, all the vibes to pass your exam. The whole life video is probably going to be double or triple this length. So term is relatively simple, whereas whole life is going to be a little bit more complex. But again, remember, for the purposes of the state exam, they love term versus whole, and they love to ask the differences between term versus whole. So remember, term is temporary. Term is the biggest bang for your buck, $28 for $200,000. But there is no cash value in term. You only receive the benefit if you were to die during that term, unless you had a return of premium rider, which allows you to get the premium back if you never use the insurance, but you're going to have to pay extra for that rider. You're probably going to pay double the premium to have that rider. All right, so I'm sending you all the loves, all the vibes to pass your exam. Have an amazing day.